Todd here with Trading Analysis. So I'm at the Nasdaq here, about to go on and do Power Lunch, talking about Tesla. But I want to talk to you about the Motive Wave repository. That's the charting package I just showed you. This repository program.
Hey guys, welcome. Just doing a quick video update here. It's now Tuesday night. This is going to be a couple good things. The description are in there. There's a few topics I want to hit tonight that I think are pretty relevant to the market, and I'll set up tomorrow morning for the Wednesday live stream. We do that every Wednesday at 8:30 Eastern time, 8:45 Eastern time. It'll be the trade analysis team. It'll be myself, Terry, and Alex. So be sure to join us here on this channel that you're watching. We are streaming to a couple different platforms, so you'd want to check out either Trading Analysis YouTube or my YouTube, which is Todd Gordon. All right, 8:45. We'll see you there. All right, so quite a bit going on in the markets. To start, I want to look at the technical position of the Nasdaq. It's better than the S&P. The S&P is a mess. It is really range bound right now. Nasdaq, I think, gives us a little bit better picture here. So look at the technicals of the Nasdaq, and we'll look at some other markets as well. Kind of give us some behind the scenes, maybe a look as to what may be happening in the future. Let me do this. Get this out of here. Visibility less than. Right. Perfect. Okay, so from an Elliott wave point of view, there's good news. From the October lows, you could make the case that it is 5 waves up. We made a high above the February 2nd move there, Groundhog's Day, my birthday. On that Fed day last week, we did poke above 12.8. So that leaves 5 waves in a potential shape of a diagonal. Now, there's nothing very transparent, or there's nothing like very obvious in this market because, like, again, we're at the same price that we were back here in May of 22. And I'll pop over the S&P here real quick. I mean, this thing is a mess. It is so sideways. I am still leaning on the bullish side, but we are very aware that there are bearish scenarios out there that would involve failures at 4,100. But, you know, again, we're sideways, dude, since May of 22. I mean, we're coming up in April. It'll be 11 months of sidewaysness. So just keep that in mind, all right? So NASDAQ, again, 5 waves up. I would make the case that this counts better from November 21 down to October of 22 as a big A, B, C. All right, C wave was 618 of A, nice fib ratio there. And we also did a 1272 extension of green B down to green C. So really nice support zone there. You know, I certainly understand there's the case that you could be doing an expanding crazy ass diagonal 1, 2, 3, 4, 5, in that, you know, this is all a correction. But if this is the case, if that's a correction, I'm gonna have to get Elliott wave on you here. That's gonna have to be A, B, C, X, A, B, and you look at the distance of each motive wave within this would-be correction, that spells higher prices even if it's ABCX, ABC. It's still going to go higher. So I am still, you know, on the bearish camp here, and let's go with that for now. So in the daily, let's jump down and get down to a 60-minute chart. So here's wave 3, here's wave 4 that I just showed you. And I have the diagonal. I mean, listen, it's not easy. As I said, the markets are very sideways, very confused, very choppy with inflation and yields going every which way. And that's one of the main points I want to make in the video here. So I have this as a 3-wave diagonal. So waves 1, 3, and 5 are 3-wave moves to make up diagonal 1. Okay, so what does that mean? Well, the pullback that we've seen just over the last 2 days has been a rotation into value out of growth. And I'm thinking that we just saw 5 waves up. That would be A of 5 of diagonal 1 down in W, triangle X, and we just went down to a 618 relationship of W and Y, and we got a little bit of bump into the close today. I don't know if you guys saw that. I mean, they were trying to pound tech all day and growth all day, and all we managed to do is to go down and test that little zone. I've got pretty good fib support here, a zone ranging from 12,515 to 12,303, and we just tested the upper level and went up. So I'm kind of eyes wide open that support exists here. And again, we are looking for C wave of 5, of 1. And again, that would really round out this diagonal off the lows from October. Okay. So that's that. There's a lot going on there, a lot. Now let's take a look at internals. And this is some really, really interesting stuff, I think. Let's take a look at put to call ratio. Now, what I did here is I took the put to call ratio and I flipped it on its head. Okay, so I'm just using Thinkorswim for this. So here's the put to call ratio, which is going to be trading normally inverse of the S&P. Right, so as the S&P drops, let me get these guys away from here. As the S&P drops, more put buying than call buying, so it's going to put the put to call ratio up. And then we got a really good divergence here. We had a push down there at the end of 22, the beginning of this year. Put to call made a new high. What I like to do, guys, is when you're looking at indicators that are inverse of one another, I like to flip one on its head. So it's kind of like comparing apples to apples. So now let's look at the call to put ratio. I think it makes it easier to look at. And what I've done is overlaid a 10-period moving average and really grayed out the actual put to call readings, the day-to-day readings, and just put a 10-period moving average on it. And I think it really helps you pick up what you're trying to see. And what I see looking at this is I see a ton of bearishness in this market. A lot of people are hedged. There's a lot of fear. I mean, guys that I talked to this weekend, like colleagues and people in the business, they're like, oh yeah, market's going to crash this week. That's what they told me. Oh, okay. Hasn't happened so far. We'll see. So looking again at this moving average, I see back here in January a very significant call put spike lower. More puts were being bought than calls. So the call to put ratio dropped quite significantly. We rallied as we'd expect, and then the call to put ratio moved up, more calls being bought than puts as the market's going up. That makes sense. And then I just can't help but notice how deep this moving average, this 10-period moving average of the most recent push down in March was. That's a pretty deep reading. There's a lot of bearishness out there, and rightfully so with everything that's going on in regional financials. And the big question is it '08 again, and will we have contagion, and will it filter through? You know, we're watching the real estate market very carefully with our members. We're doing a ton of work in real estate industries, watching REITs and seeing if there are more shoes to drop, not so much in financials, but we're watching real estate, specifically commercial real estate and some other areas of finance. But there's a lot of bearishness. And if you look at that moving average, again, how low that call to put ratio is, I mean, it's on par with what we saw here in COVID. I mean, shutting down, global pandemic, maybe anarchy. I mean, that's how significant the hedging was in January. And then we saw something similar here in March. I mean, it got down to a negative 1.23 here in COVID. It got down to 1.11 in January, and we just got down to 1.08. So there's a lot of put buying there. And again, the market, what has it done? It's gone sideways. It's really gone sideways. So I think there's a lot of bearishness in this market. The other one I want to take a look at is the VIX. The VIX has some pretty good divergences. I didn't invert this one. I just wanted to keep it as is for now. But this is going to be VIX in white, S&P in magenta. So March 8th last year, VIX made a high of the initial push down from the 2022 highs. Okay, so VIX made an initial spike up to 36 as the S&P went to 4,200, whatever. Okay, and then we made 3 lower lows in the S&P. And what did the VIX do? The VIX didn't confirm. The VIX made a high in March, a lower high in June, and a next third lower high in October. So there's the first non-confirmation that the volatility couldn't break above 35 in that initial push. So we have a complacent sell-off. I think we all knew that. The second divergence is here from August down to February of this year. The VIX made a lower low. So we went from 19, call it 20, down to 18. And what did the S&P do? The S&P didn't confirm by making a new high. The S&P made a lower high as the VIX made a lower low. That's another non-confirmation. So what this is telling me is there's a lot of put buying, a lot of bearish sentiment out there. And it's a very complacent market where I think a lot of hedges have already been put on. Put buying is clearly at extremes and sentiment is clearly at extremes, but yet we have stabilization in interest rates, which is the key to what's driving this market. It's all about yields, guys. The short end where the Fed is moving and long end 10 plus year yields. It's everything, all the rotation, sector rotation, growth value, small, medium cap, large cap, market capitalization, tilt. It's so much being driven by yields here. It's so important that you understand basically what's going on with yields. So let's take a look at that. I want to pull this guy over. Now, this is kind of a fun chart to help.
There's 39 million shares outstanding. On the short side, with 125 million market total outstanding. So those shorts are really coming in. I think it's going to continue to press higher and go up and retest these old highs.